Okay, everyone, let's start with chapter number 5. So in this chapter, we are going to learn how to do equity valuation, how to find something called as the intrinsic value of a stock. So we have current market price. This is available in the stock market. And then we have intrinsic value, which we try to determine using financial model. This is stock market price. Now, the basic idea is, let's say a stock is currently trading in the market at 100, but you do your calculation and you feel that the stock should actually be trading at 120. So current market price is 100. You feel that the value should be 120. So we say that this stock is undervalued. क्यों? Because ये trade हो रहा है 100 में, but ये actually trade होना चाहिए 120. So intrinsic value is what you feel it should be the value of the stock. Now think about it. You go for shopping and let's say you find a bag or you find a product. तो उस प्रोडक्ट की प्राइस 100 है, बट आपके लिए उसकी वैल्यू या उसकी यूटिलिटी 100 से ज्यादा है, लेट्स से 120 है, तो आप वो डेफिनेटली खरीदोगे बिकॉज इट इज यू फील दैट इट इज अंडर प्राइस. बट ऑन दी अदर हैंड एक प्रोडक्ट है जो आपको 1000 रुपए में मिल रही है, बट आपके हिसाब से 1000 रुपए में डालूंगा तो उससे बेनिफिट मुझे 800 का ही मिलेगा, तो ऑब्वियसली इट इज नो पॉइंट इन स्पेंडिंग 1000. So current market prices, you are able to purchase something at 100 और ये intrinsic value वो utility है, मतलब आपके लिए वो क्या value रखती है. So you are able to find the intrinsic value using financial modeling. On the other hand, let's say the stock is currently trading at 500, but you feel that इसकी future potential के हिसाब से इसका value सिर्फ 450 होना चाहिए. So trading at 500, value should only be 450. This stock is overvalued. Overvalued है तो either you will exit or you will go for short selling. Basically, you will sell this particular stock, or undervalued hai, you will buy this. So this is the primary concept and logic that you should keep in mind in this chapter. If the stock is undervalued, I will buy it. If the stock is overvalued, I will sell it. Undervalued, overvalued kaise malum padega? We compare the current market price with the intrinsic value. You are able to buy the stock at 100, but actually mein uski value honi chahiye 120. Will buy it. You are able to buy the stock at 500, but future potential calculation के हिसाब से 450 उसका value होना चाहिए, तो overvalued है, you will sell it, you will exit, or you will not buy. So over here we are going to see how to find the intrinsic value of the stock using various model, expected cash flow, growth rate, investors required rate of return. So you will have some mathematical calculations over here, and we'll be able to find out undervalued and overvalued stocks for making better investment decisions. So this I've already explained. Actual price is 100. It is greater than the fair value. Fair value is only 80. So security is overpriced and you should sell it. Fair value is nothing but your intrinsic value. Actual price is 100. Fair value should be 120. Security is underpriced. You will buy it. If the analyst doesn't know when the stock price will move towards fair value, they can't make a practical buy-sell decision based on the mispricing. So let's take this example. Currently, it is available at 100. You know that, or you feel that कि ओवर अ पीरियड ऑफ टाइम ये इंक्रीज होकर 120 तक पहुंचेगा, बट ये 120 तक कितने दिन में पहुंचेगा, दैट इज इंपॉर्टेंट. अगर ये 120 में 2 दिन में पहुंच जाएगा तो इट्स रियली गुड इन्वेस्टमेंट. अगर ये 120 10 साल लगाएगा पहुंचने, देन इट डजंट मेक सेंस टू ब्लॉक माय मनी ओवर हियर बिकॉज आई विल फाइंड बेटर इन्वेस्टमेंट अपॉर्चुनिटी और बेटर टाइमिंग. सो वी शुड नो व्हेन दिस स्टॉक प्राइस इज एक्सपेक्टेड टू मूव टुवर्ड्स फेयर वैल्यू. अगर ये फेयर वैल्यू की तरफ मूव हुआ ही नहीं, ओनली यू फील दैट इट इज अंडरवैल्यूड, बाकी लोगों को ऐसा कुछ दिखाई नहीं, तो they will not buy. If they don't buy, the prices will not increase. So intrinsic value is also important, and when the stock will achieve this target, that is also you will have to predict. So that is why in equity analysis we have fundamental analysis as well as technical analysis. Technical analysis helps you to find the momentum. So models which we can use are the discounted cash flow, which is DCF, dividend discount model. In this we will also use the free cash flow model, which is FCFF and FCFE. We can also find the valuation of the stock using price multiples like PE ratio, enterprise value, which is EV by EBITDA. And then we can also do a valuation of the assets, net asset of the business. ये NAV approach है. NAV approach is helpful for valuing mutual funds. So analysts can find a justified value or the fair value or the intrinsic value based on fundamentals and formulae. Actual price is determined by other factors like speculations. So market में जो behavioral finance elements होते हैं, that determines the actual price. Whenever lost in the formula, always remember that we are trying to find a justified fair value share of a company. We are trying to find intrinsic value of a company. So we should do some kind of forecasting. So as a finance manager, you have to take 3 decisions. Financing decision. How to raise money at a cheaper cost, at a low cost. Because if you're raising money in the form of debt, you will have to pay interest. If you're raising money in the form of equity, your shareholders will want certain return. और ये सारा पैसा raise करने के लिए you will take the help of an investment bank. They are going to charge you some flotation cost as well. So how to raise the optimum finance? Investment decision. If you have money, you want to make investments, where can I make the best possible investment so that I can maximize my return? Dividend decisions. अगर profits है तो equity shareholders को dividends दोगे तो shareholders become happy. More dividend you give, more people are interested to buy the share. So how to distribute the profits in the optimal manner? You must also decide, should I give dividends or should I retain this profits for future expansion? So decisions have to be taken over there as well. The common objective in all these three is maximize the shareholders' wealth. Now, if I take debt, it will come at a cost. The cost means I have to give them interest. Interest means eating away the profits of the company. So profits se agar interest ka payment nikal jayega, whatever payment is left, only that can be given to the dividends. So if I give more interest, I will have less money for dividends. So share of stock is the risk capital invested in the business. It is your own money. Then you can take bank loan, you can issue bonds, debenture. These are borrowed capital. So equity shareholders receive common dividend, preference shareholders. Now preference shares are relatively less. They get preference dividend and debt holders are paid interest. Now out of this, interest is compulsory. Preference dividend must be paid before equity dividends are paid. Preference dividend is paid only when there is profit. So only when there is profit, you pay these two. But equity holders को dividend देने से पहले, you always have to give dividend to the preference shareholders. So let's say you are left with 100. सबसे पहले पैसा जाएगा interest pay करने को. उसके बाद if some money is left, it will go to pay the preference and ultimately then only to the equity shareholders. So return to the debt holders is interest. Return to the equity holders is dividend, common dividend, and return to preference shareholders is preference dividend. Now, company can give you dividend either in the form of cash or it can give you more shares free of cost. So cash dividend is giving cash for every share you have held. So let's say cash dividend is paid as a percentage of par value. So let's say you are holding a share at $100. The company is giving you a $5 dividend. So you are going to get $5 in cash. You have to pay taxes on the dividend if it is taxed in your country. So payment to shareholders in cash can be regular. That means company can give you every year, or it can be special once in a while, maybe even twice in a year or more than 2 times in a year. It can be paid consistently. Example, quarterly. It can be paid semi-annually. It can be paid annually. For example, Vedanta gives 2-3 times dividend in a year in India. Hindustan Unilever gives 2-3 times dividends in a year. There can be some special dividends also be given by some companies whenever they have made any strong profits, or let's say they have sold any particular unit. So they can give you some special dividends. Special dividends are irregular in nature. Now, instead of giving you dividend in cash, company can issue new shares as well. So that company can give you free shares as well. So let's say this is called as bonus. So let's say the bonus is 2:1. So if you're having 2 shares, you are going to get 1 share free of cost. So this you have and this you will get now for free. So instead of giving you dividends in the form of cash, the company is giving you additional shares. So increase in the shares outstanding, the share prices is adjusted downwards. The total share equity is unchanged. So let's say you are having right now you're holding 2 shares. The value of the share is $150. So total value of your portfolio is $300. If the company is giving you 1 share free of cost in the form of dividend, you will have 3 shares, but the value of your portfolio is going to remain only 300. So that means the share price, current market price, will now become $100. So you might be wondering कि तो फायदा कहाँ? 2 share की जगह 3 shares में share price तो कम हो गया, 150 का became 100, portfolio value is the same 300. But think about it. यहाँ पे if the company decides to pay cash dividend of $5, तुम्हें यहाँ पे कितना cash dividend मिलेगा? 2 multiplied by 5, you will get $10. But यहाँ पे next year if the company decides to give you cash dividend, तुम्हें कितना मिलेगा? 5 multiplied by 3, you will get $15. So अभी तुम्हें फायदा नहीं दिखेगा, फायदा you will see in the long run. So again, if you have only 2 shares, company will give $5, you will get 10. But यहाँ पे तुम्हें इस साल bonus मिला है, next year तुम्हें अगर cash dividend मिले, तो यहाँ पे तुम्हें cash dividend मिलेगा $5 पे, or multiply by 3 shares, you will get $15. Then there can also be some kind of share repurchases. So company wants to give you return instead of giving you dividend. It is buying back shares from you at a higher price. So let's say the current market price of this particular share is 100. Company will say that तुम ये शेयर हमें बेच दो at a price of 125. So I'll give you 25 rupees more per share. So that is your profit. That is another way of distributing profits to the shareholders. So company buybacks its own share. It is alternative to giving cash dividend. It is having the same effect on shareholders' wealth. It is used to support share price, signal undervaluation, or offset dilution from employee stock options. So we'll discuss these points. Whenever company decides to buy back its own shares, so it sends a signal to the market that अगर कंपनी तुम्हें 100 रुपए के शेयर के लिए 125 दे रही है तो एक्चुअली इसका वैल्यू कितना होना चाहिए 125. So shares are currently undervalued. So more people will start buying the stock price will go up. And then there are some employee stock options, ESOP. So let's say मेरी कंपनी में 100 शेयर है, ठीक है, and let's say I am the 100% shareholder. मैंने 10 एम्प्लॉइज को शेयर्स दे दिए. सो व्हाट विल हैपन, दे विल गेट नाउ 10 शेयर्स. ओनरशिप में अगर मैं देखूं तो approximately let's say I am becoming 90% owner, they are becoming 10% owner. So what is happening is my ownership is getting reduced when new shares are issued. So what I'll do is, if same logic is applicable to public shareholders, what I'll do is I'll buy back shares from my shareholders. So number of shares issued total remains the same. It is also preferable in markets where capital gains are taxed lower than dividends. So in India, whenever buyback used to happen, whatever is the difference, so now company is giving you 125 for 100, this $25, you are getting this money tax free because company will pay tax on this particular appreciation or additional return which they are getting. So India, it was advantageous. If they change the tax rules, this will no longer be advantageous. Now stock split and reverse stock split is helpful in case your share price is falling, or let's say you want to increase the share, increase the number of shareholders, or you want more people to trade in your shares. So here I can give you the example of, let's say, MRF. If MRF share price is 1 lakh rupees per share, it will be very difficult for an individual to pay 1 lakh rupees to buy this share. So many people will not want to trade in this MRF. If I split that particular share into 10 shares, so 1 lakh, if I split, this is one share. If I split this one share into 10 shares, this will be divided by 10 and now the value will be 10,000 rupees. So compared to 1 lakh rupees, a share that is costing 10,000 rupees, people will be more interested to trade. Many people will be comfortable in buying. So what I'm doing is I'm splitting my one share into 10 shares. I can also do a 1/3 split. One share is split into 3 shares. I can split one share into 2 shares as well, depending on what is the share price that I'm looking for. This is not exactly a kind of return. This is only to increase the tradability. So each existing shares is divided into multiple shares. You are getting more shares. Again, the price is going to be adjusted. There is no change absolutely in your wealth. Earlier you had one share, value was 1 lakh rupees. Now you are having 10 shares in your portfolio. The value is 10,000. 10,000 multiplied by 10 is again 1 lakh. So value of your portfolio is also not changing over here. So this is more common than giving stock dividends. Now potential to gain returns from, let's say, share price appreciation also increases. So let's say you decide to sell one share and book profits. So you will be able to do this. Otherwise, if you want to sell that one share to get profits, that will also not be possible because you will be having zero investment. Companies can also go for reverse stock split. So what is the reverse stock split? So let's say one share is currently trading at $1. So if you go and say in the market, many company ka share is trading at $1, people will consider that it's a small cap stock or it's a penny stock. So people will not perceive this as a good opportunity. They will feel that ये तो बहुत ही कम price में मिल रहा है. So what I'll do is I'll make 10 shares as one share. I am combining the shares over here. So my $1 share will become $10 share. So share price will increase. It will become $10. In your portfolio, nothing is changing. Earlier you had 10 shares of $1 each. So total was 10. Now you will have one share and the value of the share is going to be $10. Again, total portfolio value is not changing. This is usually done because in certain exchanges, if your share price falls below $1 or 1 rupee, then they might delist your share because they need to follow a minimum bid quantity or minimum bid amount. So $1 ke niche, if your share price falls, people will usually go for reverse stock split to increase the value. Otherwise, there's the risk that their shares might be delisted from the stock exchange. So these are some of the ways through which company is able to distribute the profits to equity shareholders. We'll extend this session for 5-10 minutes. I'll complete the dividend portion and end it before we start the valuation. Now, in case of dividend payment, let us say a company has decided to give you cash dividend or stock dividend. You have to understand this timeline. Declaration date is the date on which the board of directors approves that, okay, we are declaring, let's say $5 dividend for every share that we are going to be held. So let's say this is August 1. So declaration date is the date on which the company declares a specific dividend, the board of directors approve, and this is the declaration date. Ex-dividend date. This is the date before which you have to buy the share so that you are getting the dividend. Ex-dividend is the date before which you have to buy the share so that you get the dividend. Now, there are a couple of things which you must understand together in order to be clear. We have something called as a record date. So let's say record date is 1st September. कंपनी saying that कंपनी आई एम मेंटेनिंग अ रिकॉर्ड ऑफ ऑल माय शेयर होल्डर्स. जो भी 1st सितंबर को मेरे बुक में जिस भी शेयर होल्डर का नाम है उनको सब डिविडेंड मिलेगा. So record date is the date. I'll check my records. Whoever is the shareholder, they will be getting that $5 dividend. So if you want your name to come in the records of the company, you will have to buy the share. If you buy the share on 1st September, your name will not be recorded on 1st September. Let's say your name is recorded on 3rd of September. We have T+2 settlement. So you are trading today, but you will get the share only day after tomorrow. Okay, so this is T+2. In case if that is the case, so if you want your shares name to appear on the company's records on 1st of September, that means probably you will have to buy the share somewhere around 30th of August. So that this is T and T+2 is 1st September, your name will appear on 1st of September. So this date before which you have to buy the share, that becomes your ex-dividend date. So ex-dividend date is the date before which you have to buy the share so that your name appears on the records and you get the dividend. Ex-dividend date is also the date the dividend amount is subtracted from the current market price. So let's say current market price is 100 and company has declared a $5 dividend. This is the current market price and $5 is the dividend. People who have the share 100, they are going to receive the $5 dividend. So that means out of the earnings of the company, $5 is going away. Think about it in that way. So that means if you have received $5 as dividend, only $95 is the actual value of share. If I buy the share today at 100, I'm going to get $5 dividend. What is the amount that I'm net paying for the share? 95. 100 मैंने दे दिया, 5 rupees मुझे dividend मिल गई 2 दिन के बाद. So मेरे जेब से कितना पैसा गया? 95. So person who is buying the share, let's say after 1st of September, he will not give you $100 because उसको dividend नहीं मिलने वाला है. He will give you less. That less amount is minus the value of dividend. So it is observed that whatever is the amount of dividend that is reduced from the current market price, and the current market price slightly falls after the dividend is paid. So now if you read, you might probably understand it better. Ex-dividend date, this is the first day when the shares trade without the dividend value. That means the shares will start trading at 95. And investors who buy the shares on or after this date does not get the dividend. So ex-dividend date, let's say it's 30th of August. You buy it before 30th of August, then only you will get the dividend. If you buy it on 30th, you will not get the dividend. Holder on the record date. The date on which the shareholders whose name is mentioned in the records of the company would be eligible for ownership is the holder of the record date. It is generally 2 business days after the ex date. So ex date is 30th August, 2 business days, 31st and 1st, which is 1st of September. That becomes your record date. Now for the CFA exam, follow this because in many countries we have a T+1 settlement and there's a lot of confusion, and in some countries they are now thinking about moving same day settlement as well. So these things will change from a practical standpoint. Don't be very confused. That's why I'm not giving you any examples of Indian companies because we don't follow T+2 settlement. We follow T+1 settlement. Whatever is there in the slide, stick to this. So what you have to understand is X date is 2 business days before the record date, or we can say that record date is 2 business days after the X date. Then payment date is the ultimate date when you are going to receive the dividend. So let's say the payment date is 15th of September. So in your bank account, you will get the share price on 15th of September. So quick revision, declaration date, board of director approves the dividend. X date, you have to buy the share before this date to get the dividend. If you buy it on the X date, you will not get the dividend. Record date, if your name appears on the records of the company as on this date, you will get the dividend. When you will get the dividend? On the payment date. So you have to remember this chronology and this time. Now we'll be learning how to value the shares using the different kind of dividend discount models. So why are we doing valuations? So we will have something called as a current market price. So this is the price of the share available on the stock exchange, let's say in the NSE or BSE. Let's say the shares are currently trading at a price of 100 rupees. Now, when we do our own fundamental analysis, technical analysis, financial modeling, and we try to identify how much should this share be worth, we call it the intrinsic value. The intrinsic value is our derived value or our perceived value. And this is the price at which the share is available in the market. So this is the value that we have derived using financial model. Now I can do a financial modeling. I can come up with the value of the share. You can do prepare your own model. You can have your own assumptions and you can find out the value of the shares as Y. Somebody will say that the value of the share is Z and so on. So each of us, based on our assumptions, we can have different intrinsic value. Now, yesterday I had said in the class that the current market price of the share is based on future expected performance and not based on historical performance. So if we expect that this share will do or has the potential to do really well in the future, people will be ready to pay a higher price for this particular share. If they feel that the future looks somewhat bleak, or let's say it's very dicey and we don't know how the business model is going to be, whether the company will be able to generate sustainable revenues. So the best current example would be Indigo. Now people are very wary that, okay, a lot of flights have been cancelled and the new regulations have kicked in. There might be some issues with the aircraft as well. There must be some software which has corrupted and it needs to be replaced. So the short term looks pretty bleak and pretty dicey for Indigo. So that's why the share price was tumbling down. So repeating my statement, the current market price is based on future expected performance of the company. So I'll be doing some kind of forecasting in my financial model and I will get a perceived value, which is called as the intrinsic value. So I did my valuation and I felt that this share should have a price of $120. Now this is the value that I feel this share must be trading, and this is the price at which it is available in the market. So you have to think about it in this way कि 120 का चीज तुम्हें 100 में मिल रहा है. So you are actually getting it at a discount. We will say that this is undervalued. 120 वाला share जिसका value 120 होना चाहिए, you are getting it at 100. So this is an undervalued share. So you will obviously buy it. On the other hand, if let's say the current market price is 150, but you feel that based on the future expected performance, the value should only be 120. So 120 वाली चीज 150 में मिल रही है. So that means it is overvalued. And if something is overvalued, either you will not invest or you will sell the share if you're having it in your portfolio. So what you have to do is you have to compare the current market price and the intrinsic value. If the intrinsic value is higher than the current market price, we say that the shares are undervalued. If the intrinsic value is lower than the current market price, we say that the shares are overvalued. Okay, I'll just write the statement here. If intrinsic value is greater than current market price, you will buy the share because it is undervalued. You can write this example 120 and 100. On the other hand, if the intrinsic value is lower than the current market price, so let's say this is 120 and this is 150, it is overvalued and you will sell. So this is the conclusion that you must remember in equity valuation chapters. Intrinsic value is what we get based on our financial modeling. Is this concept clear? And now we'll be discussing how to arrive at this intrinsic value based on the different values, which inputs which we can take. Any questions? So the first model which we'll be discussing is the dividend discount model. Now, dividend discount model is based on the rationale that the intrinsic value of the stock is the present value of future dividends. So intrinsic value, it is the sum of the future expected dividend. Now you can use this model obviously only when the stock is paying dividends. If it is not paying dividend, you cannot use this model. So the formula is we have to take a sum of the future expected dividend and we have to divide it by the discount rate applicable for that particular period. So let's say you are going to get a dividend of $5 next year and the discount rate is 8%. So I will divide this by 1.08, the whole raised to 1. If the year after that I'm going to get a dividend of $7, I'll discount it
1.08 raised to the power of 2. So if I take a total of all this, I'll get sum of the present value. So this is how the formula basically looks like. Now I'll give you some formulas which you will have to write because it's somewhat easier. I'll write it over here. If you are holding the stock for 1 year, okay, then the value of the share V0 today, the intrinsic value, will be equal to D1, which is the next year's expected dividend, plus P1, which is the value of the share at the end of year 1, and you will divide it by 1 plus R. It is 1 plus R raised to 1. We need not write that. So D1 is next dividend. P1 is closing price of year 1 at the end of year 1. So value today is equal to D1 plus P1 divided by 1 plus R, and it is raised to 1. So you will use this model if you are planning to hold the stock for 1 year, or let's say you are having a 1 year perspective. If you're holding the stock for 2 years, so value of the stock today will be equal to D1 divided by 1 plus R plus D2 and P2 divided by 1 plus R raised to 2. So over here, D1 is the expected dividend at the end of year 1, D2 at the end of year 2, and P2 is the closing price at the end of year 2. If you're planning to hold it for 4 years, value will be equal to D1. This will be 1 plus R raised to 1 plus D2 divided by 1 plus R raised to 2 plus D3 divided by 1 plus R raised to 3 plus D4 and P4 divided by 1 plus R raised to 4. Okay. And depending on 5 years, 6 years, it will vary accordingly. So this is if you are having a 1 year perception, having a 2 year perception, and having a 4 year perception. Now there are some more formulas. D1 is equal to current dividend multiplied by 1 plus G. G is equal to growth rate. That means the rate at which your dividends will be growing. And G can be calculated using the formula retention rate multiplied by return on equity. Retention rate is equal to 1 minus dividend payout rate. So in short, if the company is paying out 40% dividend from the earnings, then retention rate will be equal to 60%. Okay. D1, it is current year's dividend and it is expected to grow next year. So it is multiplied by 1 plus G, where G is the growth rate. G can be calculated. This is the first method of calculating G. The formula is retention rate multiplied by return on equity. Retention rate can be calculated as 1 minus dividend payout rate. The dividend payout rate is 40%, then the retention rate is 60%. So this is one way to calculate the growth rate. The second way to calculate growth rate is CAGR. And CAGR formula is ending value divided by beginning value, the whole raised to 1 upon n minus 1. So this is the second method of calculating growth rate, and this is the first method of calculating growth rate. Are the formulas clear so far?
Yes, sir.
So I'll again write the 4-year model. So V0 will be equal to D1 divided by the discount rate plus D2 plus D3 plus D4 plus P4 divided by, it will be 1 plus R raised to 4. And this will be discounted at 1 plus R raised to 2 nth. Now this P4 is calculated as D5 divided by K minus G, or you can also write R minus G. So this is known as the Gordon growth model. What we assume is after the 4th dividend, the dividend will continue to grow at infinity. I mean, we cannot do a financial modeling for like 100 years or 200 years. We'll assume that the dividends are expected to grow in future at a constant rate for an indefinite period of time. Okay, so P4 can be calculated as D5, which is the next year expected dividend, divided by K minus G. So I can also write it in this way. P4 is equal to D4 multiplied by 1 plus G divided by K minus G or R minus G. K and R is the cost of equity. Is this part of the formula clear? I've told you how to calculate D1, D2, D3 and D4. P4 is equal to D5. D5 is what? D5 is D4 multiplied by 1 plus G. Divided by, you have to do R minus G, where R is the cost of equity and G is the growth rate. In order to use this formula, your R has to be greater than G. So let's say this is 10% and this is 8%. The formula will work. But if this is 10% and G is 12%, this formula cannot be used because 10 minus 12 will give you a negative. So in order for this formula to work, the R has to be greater than G. Is this clear?
Yes, sir.
Yeah. Okay. So these are the formulas which we have just discussed. So it is expected that the investor will sell the share at the end of year 1. So 1 year holding period, the formula is D1 plus P1 divided by 1 plus K. K is the cost of equity. Now another formula I can tell you, the KE or the R can be calculated using the formula CAPM. Have you done this formula before? CAPM, capital asset pricing model, where CAPM is equal to risk-free rate plus beta of the stock multiplied by expected return from the market minus the risk-free rate. So this KE or R can be calculated using the formula risk-free rate, the rate of return, the yield that you get from a government bond, plus beta of this particular stock we are trying to value. Let's say if you're trying to value Reliance, you have to take the beta of Reliance. This is the expected return from the broad market. For us, the broad market will be Nifty or Sensex. And this is again the risk-free rate. So a lot of formulas over here, and equity has got very limited questions, but the questions are very easy. You just have to remember the formula. There are a lot of formulas. Holding the stock for n number of periods, it is going to be D1 divided by 1 plus KE, then D2. Then depending on how many periods you are holding for, we have to take the DN and the P. If you are holding it for 2 years, it is D2 and P2 divided by 1 plus KE. Again, you are holding the stock for an indefinite period of time. If the company is not paying dividends, then you will not be able to use this formula of the dividend discount model. So in that case, you have to use a different formula. You have to use the free cash flow to the equity. So if the company is not paying dividends, you will use free cash flow to the equity. Now, FCFE means how much money the company has after it has made provisions to meet the working capital requirement and to do any kind of fixed capital investment in property, plant and equipment. It also includes any amount raised from debt holders. So if you're taking a bank loan or if you're taking a debt, this money can be utilized for the benefit of the equity shareholders. So let's see the formula. Free cash flow is used in DCF valuation as an alternative to dividends because it measures the cash available to common shareholders. It represents the firm's capacity to pay dividends. So if you're not paying me actual dividends, I will test your capacity to pay dividends. FCFE is the cash remaining after meeting all debt obligations and funding required capex as well as any working capital requirement. It reflects the cash available to equity shareholders after all other claims are satisfied. This formula is also there in your FSA subject, but we'll be using the formulas given over here. Free cash flow to the equity holders can be found from net income. This is my profit after tax. In that, I'm going to add depreciation and amortization because these are non-cash expenses or non-cash charges. So I will write NCC. After that, I have to make provisions for working capital investment and fixed capital investment. If I have made any debt repayments, I have paid money back to the bank, I will reduce it. It's a minus sign. And if I've raised new money, I will include it. It can also be calculated using the formula CFO. It is cash flow from operations, what you get from the cash flow statement. If you have completed FSA, you will be able to understand this. Otherwise, FSA, when you will do it, you will understand what is CFO if you have not done this in your graduation. And from CFO, we are going to reduce the fixed capital investment and we are going to add net borrowing. The depreciation and amortization and the working capital investment adjustment is already done in the net income. Then only you get the CFO. So this is a short formula. And net borrowing is the debt issued minus the debt which is repaid. So if the question gives you an income statement and a balance sheet, you will be deriving these values. You'll be calculating the FCF. So we'll see some examples in which we have to do this. And then the formula remains the same. FCFE of year 1 divided by 1 plus R raised to 1 plus FCFE of year 2 divided by 1 plus R raised to 2. And you will do the valuation accordingly. Again, this is the sum of the FCFE raised to 1 plus KE. Return on equity, KE can be calculated using the formula CAPM. I gave you this formula. It is the risk-free rate plus beta of the security multiplied by expected return from the broad market minus the risk-free rate of return. There's a controversy over whether CAPM is the best model to calculate the required return on equity because, again, everything is subjective in valuation. So people can have different discount rate, different expectations. So there is no single correct number over here. Ultimately, it is what target you're setting for the stock and whether your target is achieved. For firms with publicly traded debt, the analysts often estimate the required return on common equity by adding a risk premium to the firm's bond yield. So last point says that the cost of equity is equal to YTM on the firm's debt if the firm has also issued debt plus a risk premium. Okay, so let's say I'm giving 8% to the debt holders. Equity holders will ask for 12%. So I'm adding a risk premium of 4%. Again, this is pretty subjective. This value is market driven. This is the value that you forecast based on your estimates. The CAPM model will be discussed in detail in portfolio management. Moving on. Now, in order to calculate the value of preference shares, till now we have learned about how to calculate the value of equity shares. So preference shares, value of preference shares is equal to the dividend that you are expected to receive in preference because let's say we are doing a valuation of ordinary preference shares. So over there, the preference dividend amount is fixed. Let's say 10%. Now, preference dividend can be paid in different types, but we are assuming that it's a normal preference shares. So the dividend is going to be fixed. So it is the preference dividend that you're going to get divided by cost of preference shares. If the cost of preference share is, let's say, 10%, your denominator is going to be 0.1. If it is 8%, it is going to be the preference dividend divided by 0.08. And it's a very simple short formula. It is the dividend divided by the expected discount. So dividend should be discounted using a rate commensurate to the risk involved with the preferred stock, which is generally lower than the common shares. So if the cost of equity is 15%, the cost of debt will be, let's say, around 8%. So this is the cost of debt. This is the cost of equity. The cost of preference share will be somewhere in between. Let's say it is 11%. So cost of debt is always lower. Then we have cost of preference shares and cost of equity is always higher. So this is what the debt holders are demanding 8%. This is what the preference holders are demanding 11. And this is what the equity holders are demanding, which is 15. If the subject share is a special category of preferred stock like participating, convertible, etc., then the total dividends and the discount rate will also vary. But this is not there in the syllabus. We are just assuming that it's an ordinary preference share. Moving on. So here's an example. The discount rate is 8% and the preference dividend is $4. So value of the preference share will be equal to 4 divided by 0.08, which is $50. It's as easy as that. Value of the preference share is just the preference dividend divided by the discount rate. You have to remember it is not 1 plus discount rate. It is only the discount rate. Moving on. So Union Electric Company has issued 4.75 perpetual preference shares. So that means this preference shares do not have a redemption date. The company will pay you the preference dividend lifelong. And it has got a required rate of return of 7.5%. So this is the cost of preference share. And this is the dividend that you're getting. Par value is 100. There are no embedded options. That means it is not callable or puttable or convertible or anything like that. Okay, so value of the preference share is going to be, let's say it's $100. So you're going to get $4.75 as dividend. And you're going to divide it by 0.075. So the value is around 63.33. Okay, so this is the intrinsic value of this preference share. So we have calculated this. Would the value be higher or lower if the share was callable? Now, I don't know whether you are aware of this callable and puttable options in debt as well as in preference shares. So I'll just explain it to you in a couple of minutes. If let's say the preference share or the bond or debenture, if these are callable, it means that the company has issued the preference share or the bond and it can ask for the bond back and it can give you the money. Let's say the bond is having or a preference share is having a maturity of 10 years and it is a callable bond or a preference share. So company, let's say after 7 years, the company has decided that, okay, I have enough money. Let me take back the bond and let me give you back the principal amount. So let's say the principal, the preference share or the bond was available at a price of $100 and they have promised you a return of 6%. So you are expected to get $6 every year for the next 10 years. Doesn't matter whether it's preference share or bond. And at the end of 10 years, you will get back this $100 that you have invested. After 7 years, the company has decided that, okay, we have enough money. Let us call back the preference share and bond. That means we are asking the preference shareholders and the bondholders to surrender the bond or the share back to the company. We will give them back the $100 and no need to pay them $6 for the remaining 3 years. So this is called as a call option. You can also have a puttable bond. In a puttable bond, after 7 years, you decide that no, I want my money back. So I return my preference share or the bond back to the company and I ask for my money back. Okay. So the call option, it is with the company, and the puttable option, it is with the investor. So the callable option is with the company. For us, this is the risk. If there is a risk, we will demand higher return. Okay. So now the next question is, what will be the value of the share if it was a callable option? Now, if it is a callable option, that means it's a risk for the investor. So the investor can do two things. The investor can ask for a higher dividend, or the investor will say that I will pay you a low price. So either the dividend has to be high or the price has to be lower. That means for $100 bond, I will give you only 90 and you will give me whatever is the dividend. So these are the two things if it is a callable share or a bond. So what will the value be higher or lower if the share was callable? Obviously, the share price or the value of the preference shares will be lower, or the dividend has to be higher. So you have to know this for the exam perspective. If it was a puttable bond, then you are having the benefit. You can return the bond to the company anytime you want. So if it's a puttable bond, your dividend will be lower and the price will be higher because people will be ready to pay a premium in order to buy this kind of share or bond, because you will be able to return it to the company whenever you want and you will take back your money. Is this clear?
Yes,
Yeah.
sir. Yes.
Chalo. So the conclusion over here, if it is a callable preference share or a bond, two things must happen. Either the dividend should be high or the price should be low, and vice versa for puttable preference shares or bond. The dividend expectations is low and people are ready to pay a premium, so the price will be high. So remember this for the exam, and this slide is taken care of. Gordon growth model, I have also explained you this. We are able to get the value of the share. Dividend is expected to grow. So we have D1 and we have in the denominator KE minus GC. So let's say I want to find the value of P5. To find P5, what I'll do is I'll take D6 divided by K minus G. D6 is what? D6 is D5 multiplied by 1 plus G divided by K minus G. So V0 will be equal to D1 divided by K minus G. D1 is equal to D0 multiplied by 1 plus G divided by K minus G. Okay. So the formula, let's say it's a 2-year dividend discount model. So we have D1 plus D2 plus P2 divided by 1 plus K raised to 2 or R raised to 2, and this is 1 plus K raised to 1. This P2, we call it as a terminal value. That means the share price. So let's say this is a 2-year model. That means you are planning to sell the share after 2 years. So you will get a dividend at the end of year 1. You will get a dividend at the end of year 2. And at the end of year 2, you are planning to sell the shares. So this P2 is actually your expected selling price at the end of year 2. So that is why this P2 is called as a terminal value. So terminal value is calculated using this Gordon growth model. And for this model to work, the only requirement is K has to be greater than G. If K is less than G, this model cannot be used. Okay, so terminal value, Gordon growth model, the condition is K has to be greater than G. So moving on, the Gordon growth model assumes dividend are an appropriate measure of the shareholders' wealth. So for you, dividends are very valuable. The constant dividend growth rate GC and the required return on the stock KE are never expected to change. So if you're having a 4-year perspective for the 4 years, you are assuming that the cost of equity and G is the same. Now, this is a bit unrealistic. Because it is a bit unrealistic, then that's why the dividend discount model and the CAPM, everything is questioned. But fine, theoretically, all this works. K has to be greater than GC, otherwise the model does not work. If any assumption is violated, the model does not work. And instead of taking dividend, you can also take FCFE. So let's see an example. So using the data from Siemens below, work out the historical growth rate CAGR and DPS and find the sustainable growth rate G is equal to B multiplied by ROE, where B is your retention rate. So data is given 2013, 14, 15, 16, 17. These are the closing values or year-end values using the historical growth rate and the required rate of return. Okay, so KE is given to us. It is going to be 7.5%. We have to find the intrinsic value of a Siemens share. So let's write down what values we have. We have KE and this is 7.5%. We are trying to find the value of, let's say, 2018, assuming we have like a 1 year holding period. The recent dividend paid is 3.7. So for me, this is like D0. D0 is 3.7. This is the current dividend which is paid. And then I need G. In order to calculate G, I need retention rate and I need ROE. If I have these two values, I'll be able to calculate G. So let's see, ROE is given to us. So if we have been given ROE for multiple periods, the best thing to do over here is to take an average. Now we have 1, 2, 3, 4, 5 year data. What we'll do is we'll take a total of all this and we'll divide it by 5. So if we do that, we get the average return on equity answer as 17.3%. So ROE is equal to 17.3%. What we have done is we have been given 5 year data. We have taken an average. Then we need the retention rate. Retention rate is equal to 1 minus payout rate. So retention rate is equal to 1 minus payout rate. So retention rate is not given to us directly. What we'll do is we will calculate it from the payout rate. So payout is 50%. So retention rate is also 50%. If it is 53, retention rate is 47. If it is 40, it is 60. 52 means 48 and 59 means 41. So they have given us the payout rate. We have calculated the retention rate. So we have 5 year data. We'll do the same thing. We'll take an average. So we'll take a total and divide it by 5. We are getting the retention rate as 49% approximately. So retention rate is 49. Return on equity is 17.3. G is equal to, now the best way to do this, take one in decimal and take one in whole number. Your answer will be in the required percentage. So I'll take it as 0.49 and I'll multiply this by 17.3. So the answer I'll get is 8.5%. So G, I'm getting the answer as 8.5%. Next, you have to check, is my K greater than G? Now that's the primary condition on which the dividend discount model is based. My K is only 7.5. My G is 8.5. So I cannot use this model because the K is less than G. So ये method तो काम नहीं आएगा. But G calculate करने का एक और formula है. G is also the CAGR. ठीक है? D is the CAGR what? D is the CAGR of the dividend per share. So dividend was 3 and it has increased to 3.7. ठीक है, यहाँ तक सब clear है? Any doubt? Because I'll erase this and then I'll do the remaining calculation. ठीक है, first you see the question, you write down what data is given. K is given to us, तो मैंने लिख लिया 7.5. Latest dividend मुझे पता होना चाहिए, which is 3.7, वो मैंने लिख लिया. फिर G मुझे calculate करना है. We have to use the formula retention rate multiplied by return on equity. तो हमें एवरेज वैल्यूज निकालने हैं और उसको मल्टीप्लाई करके वी आल्सो कैलकुलेटेड जी. फिर हमने देखा कि K इज लेस देन G, तो ये फॉर्मूला यूज नहीं होगा, तो वी विल यूज द सेकंड मेथड टू कैलकुलेट ग्रोथ रेट व्हिच इज द CAGR. हमें किस चीज का CAGR निकालना है? DPS का, माय डिविडेंड डिस्क ग्रोथ. एनी डाउट?
No, sir.
ओके, सो आई इरेज दिस. G निकालने के लिए CAGR फॉर्मूला इज एंडिंग वैल्यू डिवाइड बाय बिगिनिंग वैल्यू द होल रेज टू 1 अपॉन n माइनस 1. ठीक है, तो एंडिंग वैल्यू है मेरे पास 3.7, तो मैंने लिख लिया 3.7. ओपनिंग वैल्यू है मेरे पास 3, तो मैंने 3 लिख लिया. होल रेज टू 1 अपॉन n. अभी n क्या लेना इज द क्वेश्चन. हमें क्लोजिंग वैल्यूज दिए. क्लोजिंग वैल्यू ऑफ 1 ईयर इज द ओपनिंग वैल्यू फॉर अनदर ईयर. तो ये जो 3 है ये 2014 का ओपनिंग वैल्यू है. क्लोजिंग ऑफ ईयर 2013 बिकम्स द ओपनिंग वैल्यू ऑफ 2014. तो न्यूमरेटर मेरा 2017 का डेटा है, डिनोमिनेटर मेरा 2014 का डेटा है. सो n इज 4. ठीक है, फॉर्मूला क्या बोल रहा है? एंडिंग वैल्यू डिवाइड बाय बिगिनिंग वैल्यू, और हमें ये टेबल में सारे एंडिंग वैल्यूज दिए हैं. 2013 का एंडिंग वैल्यू बिकम्स 2014 का ओपनिंग वैल्यू. तो मेरे डिनोमिनेटर में जो 3 लिख रहा हूँ वो एक्चुअली 2014 का डेटा है. तो 2014, 15, 16, 17, n is 4 and n is not 5. So this is what you have to be careful about. If I solve this, I get the answer as 5.4%. So my dividends have grown by 5.4%. My KE is 7.5 and my G is 5.4. Now I can use the formula. ठीक है? समझ में आया?
Yes.
V0 is equal to D1 divided by R minus G. This is our formula. D1 is equal to D0 multiplied by 1 plus G divided by R minus G. D0 is my current dividend. Current dividend is 3.7. So I'll take 3.7, multiply this with 1.054, which is the growth rate I got from my CAGR, divided by 0.075, which is my K, minus 0.054, which is my G. So if I solve this, I get the answer as 185.70. So the intrinsic value of my share is 185.70. Now I'll compare this with my current market price. Let's say my current market price is 160. Now tell me, is the share overvalued or undervalued? Market में मिल रहा है 160, intrinsic value है 185. क्या ये overvalued है कि undervalued?
Undervalued.
Correct. तुम्हारे हिसाब से इसकी वैल्यू कितना होना चाहिए? 185. ये कितने में मिल रहा है? 160. You are getting it a discount. Discount है मतलब undervalued. Undervalued है तो क्या करना है? You have to buy this share. ठीक है? Is the concept clear? We'll do one more question. So moving on. A company does not currently pay a dividend but is expected to do so in 5 years. ठीक है? तो मुझे D5 है $4. ठीक है? 5 साल के बाद मुझे डिविडेंड मिलेगा तो D5 is expected to be $4. This is expected to grow at 6% into perpetuity. So G is the perpetual growth rate. G मुझे दिया है 6%. चलो अच्छा एक काम कम हुआ. Required rate of return K is also given to us. Very good. K is equal to 10%. Now I have to calculate what is intrinsic value today. So I have to calculate V0. तो सबसे पहले डेटा देखते हैं हमें क्या मिला है. हमें डेटा में दिया है D5, G and K. If you check the formulas that we have written, V4 is equal to D5 divided by K minus G. ये formula है. The value of the share, intrinsic value of the share at the end of year 4, it is equal to D5 divided by K minus G. So we have $4. This is the K and this is the G. So my V4 is coming as $100. 4 साल के बाद the value of my share is going to be $100. तो आज की value क्या है? आज की value will be 100 divided by 1 plus R raised to 4, which is 100, divided by 1.1 raised to 4, which is 68.3. So this is my intrinsic value. ठीक है? तो मैं सबसे पहले डेटा देखना है, फिर सोचना है कि क्या फॉर्मूला यूज होगा यहाँ पे, and then you just have to plug in the numbers. So this is a typical exam question and it's relatively very easy. Any doubts?
No, sir.
Yeah. Let's see one more example. Current dividend is 5. Growth is expected to be 10% a year for 3 years and 5% thereafter. So this is the 2-stage growth models. So initially dividends will be growing at a higher rate and then dividend will be growing at a stable rate for perpetual period. तो 3 साल के लिए 10% ग्रोथ है और उसके बाद 5% टिल परपेचुइटी. रिक्वायर्ड रेट ऑफ रिटर्न K मुझे दिया है 15%. इन दिस क्वेश्चन आई हैव K, आई हैव GS and GL. GS is the short term growth rate, GL is the long term growth rate. My K is how much? My K is 15%. I have to check GS क्या है? 10%. K always has to be greater than G. ठीक है, यहाँ पे कंडीशन फुलफिल हो रहा है. GL is 5%, यहाँ पे भी K is greater than G, the condition is getting fulfilled. D1 is 5.5, D2 is 6.05, D3 is 6.55. आज का डिविडेंड D0 next year will become 5 multiplied by 1 plus G और G है यहाँ पे 10%. D2 is going to be 5 multiplied by 1 plus 0.1 raised to 2. This is 0.1. D3 will be today's dividend multiplied by 1 plus 0.1 raised to 3. D4 is going to be 5 multiplied by 1.01 raised to 3 and then 1.05 से multiply करना है because 3 साल तक it will grow by 10%. So 1 plus 0.1 and then उसके बाद it will grow at 5% thereafter. अब मुझे इसकी वैल्यू निकालनी है. So सबसे पहले formula is D1 divided by particular discount rate, D2 plus D3 and P3. ठीक है, P3 निकालने के लिए मुझे क्या चाहिए? D4. D4 divided by K minus G, इससे मुझे मिलेगा P3। तो क्या मेरे पास सारा डेटा है? P3 में D4 है मेरे पास, K क्वेश्चन में दिया है, G क्वेश्चन में दिया है। D3 is going to be 6.65, so 6.655 multiply by the long term growth rate divided by K minus G. यहाँ पे याद रखना है G तुम्हारा long term growth rate. If you do this, you get the terminal value as P3 69.8875. Then you have to just plug in the numbers and do the calculation. So take a couple of minutes, see if you have understood this. Once you have gone through, give me a yes or no, and then I'll proceed.
Yes, sir.
Okay. So here they have explained how do you arrive at G. So estimating growth rate in dividends. Analysts can estimate dividend growth using three methods. One is historical dividend growth for the firm. So this is what you get if you analyze the historical data. This is the median industry growth rate. So you will see how much other firms are paying and what is the midpoint over there. And then we calculate the SGR using the data P multiplied by ROE. So sustainable growth rate is the rate at which equity earnings and dividends can grow indefinitely, assuming the ROE is constant, the dividend payout ratio is constant, and no new equity is issued. So these 3 points are important from a theoretical perspective for G. Sustainable growth rate SGR is equal to 1 minus payout rate, which is the retention rate, multiplied by ROE. Retention rate is the portion of net income kept in retained earnings. So the amount the company is flowing back in order to make future investments. Some firms do not currently pay dividends, but are expected to begin paying in the future. So we also saw an example where a company is not going to pay dividend for 4 years, then D5 onwards, they'll make a payment. This may occur due to financial distress or because reinvestment earns higher returns than shareholders could earn elsewhere. So if it is a growing firm or it is a startup firm, the company will not pay dividends because we need money for expansion. If we earn money, if we earn profits, and if we give away all the profits to the equity holders, पैसा नहीं बचेगा in order to grow. So फिर क्या करना पड़ेगा? फिर लोन लेना पड़ेगा. Loan comes at a cost. इंटरेस्ट कॉस्ट जो है वो इक्विटी शेयर होल्डर्स के लिए अच्छी बात नहीं है बिकॉज प्रॉफिट्स इंटरेस्ट पे करने में चले जाएगा. So there is benefit in raising debt. Sometimes it is not beneficial to raise debt. We have to think about the situation, the market conditions, the future potential. हमें पैसे क्यों चाहिए? So on a simple note that if I pay all the dividends to the equity shareholders, whatever I am earning, I will not have money for future growth. तो मैं dividend आज नहीं दूंगा. I'll retain back the money. I'll invest it for future growth. Then in future I am able to pay a higher or better dividend. For such firms, the analyst must estimate the amount and the timing of the first dividend to use the Gordon growth model. So you can use all this model only when you are able to predict that 4 साल या 5 साल के बाद the company will start paying dividends. Because these estimates are highly uncertain, the result should be checked against other valuation methods. So you can use dividend discount model, but if you are not able to come up with a reasonable estimate that कितना dividend होगा, कितने से grow होगा, so use FCFE. Or there are other valuation models which you will learn. There can also be multi-stage growth models where, let's say, my short-term growth rate in dividends is going to be 15%. Then after some time, I will cut this down. I'll pay 10%. And then the long-term growth rate is, let's say, somewhere around 8%. So even these kind of calculations are possible. So firm may temporarily experience a growth rate that exceeds the required rate of return on equity, but this cannot continue indefinitely. So they are saying that in the short run, it may be possible that K will be less than G, but this situation will reverse in the future. So I am expecting that the company will give me 10% return, but the company is actually giving me 15% return. So super normal profits hai. I'm expecting company to earn 10, give me 10, but the company is actually able to pay me 15. तो ये देख के क्या होगा? People will assume that ये industry बहुत profitable है and new players will enter into the market. If new players enter into the market, existing firms की profitability शायद कम हो सकती है. Why? Because people will switch, substitution effect आ जाता है. तो this 15 will go down and let's say it goes down and other firm ने इसका half the share खा लिया. So this becomes 7.5%. Other firm के पास उसने 7.5% ले लिया. तो growth rate कम हो गई. People require 10. They are getting 7.5. Now this model can be used. To value such firms, we assume a transition from high growth rate to stable growth rate, and then we can use this model. So we'll assume that over a period of time, the growth rate in dividends will come down and the long-term growth rate is going to be 8%. So this is the value that I'll use in the Gordon growth model. This is what I'll use in K minus G. Okay, this 8%. The steps in multi-stage DDM, you have to estimate the discount rate. KE can be calculated using CAPM. You project the size and duration of the high growth rate period. So how much is going to be GS, the time period. Then we estimate the dividends over during these period. Then we try to determine what is the constant growth rate at the end of the growth period, which is GL. We estimate the first dividend in this GL, and we are able to calculate the terminal value, and then we calculate the discounted present value. We take a total. Okay, this is terminal value, and this is intrinsic value today. When to use constant growth model, when to use multi-stage model. The simple conclusion is if it's a very mature firm like Hindustan Unilever or Britannia, so that is growing with the economy, it is paying stable dividends. So we'll directly assume constant growth model. On the other hand, if it is a growing firm like Reliance or Vedanta, so they will pay different amount of dividend every year. So you have to do a lot of estimation when you are going for the multi-stage dividend discount. So constant growth model uses a single constant dividend growth rate. So they use only one G, and this is your GL. It is most appropriate for stable, mature, non-cyclical, that means defensive utility kind of companies, and dividend paying firms. So this point is most important. It works when dividends are stable and expected to grow at a constant rate indefinite. Multi-stage model appropriate for firms if dividends are expected to be growing rapidly, slowly, or erratically for a period before stabilizing. Requirements: dividend must be estimable. This is like the first condition. It must grow at a constant rate after some initial period so that terminal value can be computed. So to calculate terminal value, you need a constant growth rate. This again is a theoretical point, which is important for the exam. It is suitable for which kind of firms? So this is again important. It is suitable for high growth firms expected to slow to a stable rate. For firms temporarily losing market share or shrinking, but expected to stabilize later. So three important points from in this slide. Any questions?
No, sir.
Okay. Yeah. Then there's a three-stage model. This is also example I've given. You have a GS, you have a growth in the medium term, and you will have a growth in the long term. So this is the growth phase, this is the transition phase, and this is the maturity phase. It is appropriate for young firms with high initial growth that gradually decline to a long, stable growth rate in the future. When DDM is not appropriate, when the firm does not pay dividend, future dividends are highly uncertain, dividend forecasting becomes speculative. In such a case, what you will do, you will use FCFP, or you will use other valuation methods like price to earnings, price to cash flow, price to book value, which we will learn now. So investor expects a share to pay dividend. So this is my expectation at the end of year 1 and year 2. So we have been given D1, then we have been given D2. At the end of the second year, the investor expects the share to trade at 40. So we are also given D2. Required rate of return is 8%. So 1.08 raised to 2, 1.08 raised to 1. Can you please solve and tell me the answer for this question? They have also given you the current market price as 40. Compare it with the intrinsic value and tell me whether it is properly valued, overvalued, or undervalued. Are you solving?
Yes, sir, I'm trying it.
Okay, yeah.
The share is undervalued.
Correct. What is the intrinsic value that you have received?
39.7641.
Correct. 39.7 is the intrinsic value. Trading at 30. So the share is undervalued. Perfect. So I hope this chapter is clear. All the formulas are fine.
Yes, sir.
Yeah. Okay. So let's see some questions. The valuation model based on free cash flow to equity it's a discount model. So it's not a multiplier model. It's not an asset-based model. It's a present value model. The first date on which the purchaser of a stock will not receive a dividend that has been declared as so it's the X date. If you buy the share on the X date, you will not receive a dividend. Can you solve question number 3?
Yes, sir, I'll try.
Yeah.
Option 3.
Option 3 correct. So it is 7 divided by 0.0775. Try question number 4.
I'm not able to solve this. So would you please solve this one?
Okay. Yeah, sure. So assume that the stock is expected to pay dividend at the end of year 1 and year 2. Dividends are expected to grow at 5% rate thereafter. Assuming that the KE is 11, we have to find the value of the stock. So in this question, we have been given what is D1. D1 is 1.25. We have been given what is D2. D2 is 1.56. If I write the model, it's going to be 1.25. divided by KE is 11%, 1.11 raised to 1, plus D2 is 1.56. I also need P2, and I'll divide this by 1.11 raised to 2. Now to get P2, the formula is D3 divided by K minus G. D3 is D2, 1.56, multiplied by growth rate is 5%, 1.05, 0.11 minus 0.01. So now I think you'll be able to solve.
Yes.
Yeah.
Is it option C?
Yeah, the answer is option C, 24.5. Okay, so whenever you come across such questions, first write down the values, then try to write down the formula. So you'll be able to find out what is the missing value and how to go about it. So next question, which of the following firms would be appropriately valued using the constant growth DDM? Okay, so they are saying constant growth DDM. Constant growth DDM can be applied only for stable, matured, non-cyclical firm. Okay, so non-cyclical firm, it is defensive firm and utilities. So let's see the option. Automobile manufacturer. Automobile is a cyclical stock. Okay, because if the economy is doing well, people buy automobile. If the economy is not doing well, there is a recession, people are not getting salary, interest rates are very high, they will not buy automobile. So it's not the answer. Producer of bread and snack foods. Okay, this is a stable firm because it is stable. It's not cyclical. It may be mature. That information is not given, but still this looks like a potential answer. Biotech firm existence for 2 years. 2 years है मतलब matured firm नहीं है. So this is not the answer. This is not the answer. The answer has to be bread and snack. ठीक है. तो CFA में you have to know the theory, you have to know the concept and options को eliminate करने आना चाहिए so that you are left with the right answer. तो in case अगर ऐसा confusion है समझ में नहीं आ रहा है तो try to eliminate. Right? Directly you are knowing the answer very good. So let's start with the last chapter. In this chapter, again, we are going to see the different methods of valuation. We have already seen the dividend discount model. So valuation helps us to calculate the intrinsic growth rate, and for that we need various kind of assumptions. So now we will be seeing the multiple based approach. So this is the second method of valuation. First method was the discounted cash flows. So price multiples are often used when the dividend discount model is too sensitive to the inputs. So again, you have to mark this. It's an important theoretical question. So dividend discount model is very sensitive to inputs. In this approach, the stock price multiple is compared with the benchmark such as an index, industry group or a peer group. So the first method or the most commonly used method is the PE ratio or the price to earnings ratio. So if let's say the particular automobile industry, let's say it's having a PE ratio of, for example, 14x, and if my stock is having a PE of 20x, so we say that industry is having a value of 14x, I am having a value of 20x, so I am overvalued. I can be overvalued, that is totally acceptable. Okay, I can be overvalued because I'm offering better quality products, I have better growth potential than the other peer group in the industry. Okay, so the only comparative measure is industry is having average of 14 and my price multiple is around 20. So if I'm more than the industry, I'm overvalued. So comparison can be made in two ways. The explanation is given using PE ratio, price to earnings ratio. Company's actual PE is compared with the actual PE ratio of the peer group or the PE ratio of the competitors or the PE ratio of the market to determine whether the stock is fairly valued over or undervalued. Fundamentals. If the actual PE ratio is compared with the justified PE ratio. Now, formula. PE ratio, the formula is MPS, market price per share, which is the current market price, divided by EPS. EPS is net income divided by number of equity shares. Okay, net income or profit available for equity shareholders divided by number of equity shares. This is the formula. Now, EPS, if I am taking historical data, so let's say I am taking EPS of last year, it is called as the PE ratio. If I am taking the expected EPS, that means EPS as per my calculation of the future, this is called as the justified PE. Okay, so justified PE, we are taking in the denominator the expected EPS. So actual EPS is based on historical data. Justified PE is based on expected data. So we have to project the dividend payout ratio. So it's another formula. Dividend payout ratio is DPS divided by EPS. If my EPS is 10 and dividend is 6, dividend payout ratio is 60%, retention rate is 40%. So a lot of formulas. We started with PE, MPS upon EPS. EPS can be expected or it can be historical. If we are taking expected EPS, we calculate the justified PE ratio. EPS can be calculated as net income or profit available for equity shareholders divided by number of equity shares. We are taking the dividend payout ratio, which is the DPS upon EPS. Let's say earnings is 6. I am paying earnings are 10. I am paying 6 as dividend. So payout ratio is 60% and the retention ratio is 40%. Cost of equity is calculated using the CFA. Return on equity, formula is net income upon equity. All these formulas are there in FSA, but I'm just making a note of it over here. It is a net income upon equity. Here we are talking about the total equity, which is share premium, reserves and surplus, retained earnings, everything. We have the formula for G, retention rate multiplied by ROE. And now the last formula. So P0 was equal to D0 divided by K minus G. I can divide both the sides by E. Okay, so this becomes my PE ratio. This becomes my dividend payout, and then it is K minus G. So this is an important formula. Initial formula is P0 is equal to D1 divided by K minus G. Sorry, this is D1. Okay. If I divide both the sides by E, this becomes D1 by E and divide by K minus G. So this is the PE ratio. This is the payout ratio. This is the cost of equity, and this is the growth. So this is an important formula. It's a new formula. Is this clear?
Yes, sir.
Okay. So if the actual multiplier 20x, benchmark multiplier 14x, the share is overpriced. So industry is having a value of 14 times x is number of times. Mine is coming as 20 number of times. So we say that the share is overpriced and it should be sold. Again, this is theoretical. My share can definitely be overpriced. I have to find out what are the reasons behind it. And if I feel that the reasons are not justified, then we say that the share is overpriced. So moving back. So there are different type of multiples that we can use. And from an exam perspective, you have to know what are the pros and cons of each method. So we have the PE ratio, and we can also calculate the justified forward PE ratio. Then we have the price to book value. So price to book value is very similar to NAV, what we use in mutual funds. We have price to sales ratio and we have price to cash flow ratio. So we have to understand which method is to be used, what are the advantages and disadvantages. So just to give you an overview, first is earnings. Earnings can only be used if earnings are positive. If my company has a net loss, I cannot use this. So in order to use the PE ratio, my company should be profitable. Then earnings are subject to a lot of manipulation because we'll be reducing the depreciation and then we'll have different kind of revaluation gains and stuff. Or sales can be manipulated. CO means different kind of cost can be raised. So management has got a good control over the how they portray or how they show the earnings. So earnings are very manipulative. So and if the company is not making profits, it is having losses, the PE ratio cannot be used. So better than earnings is the book value. So book value, the formula is equity is equal to assets minus the liability. The problem with this method is if assets are valued using historical method, for example, a piece of land was purchased in the 2000, early 2000. So at 1 CR and today the value is 5 CR in the balance sheet, we'll be still showing it at 1 CR and not the current appraised value. So book value का वो एक shortcomings है. Book value can also be negative. If the company is consistently making losses, the equity will be negative. Retained earnings तुम्हारा कुछ है नहीं. Assets तुम्हारे बहुत undervalued है, liability बहुत ज़्यादा है. That's another issue. तो better alternative is we can use sales. Sales are always positive because company cannot have negative sales. So अगर पहले दोनों use नहीं कर सकते तो हम sales use कर सकते हैं. But sales में manipulation हो सकता है. So let's say I have sales distribution channels. उसमें अगर मैं product को distribution channel में push कर दूं, I show it as sale. When I'm preparing my accounts और date खत्म होने के बाद I ask my channel partner to give me back my inventory. ठीक है, सी इन द फॉर्म ऑफ सेल्स रिटर्न. तो सेल्स में भी थोड़ा मैनिपुलेशन हो सकता है. सो आउट ऑफ ऑल दिस द बेस्ट इज कैश फ्लो. कैश फ्लो कैन नॉट बी मैनिपुलेटेड दैट इजीली. ठीक है, इफ यू से दैट यू आर हैविंग मनी, वी कैन सब्सटेंशिएट इट बाय शोइंग द बैंक स्टेटमेंट और showing by counting the cash we have or valuing the investments which we are holding. So this is just a quick summary of what are the advantages and disadvantages of the methods. Let's see it in detail. So if you're using the PE ratio, why PE ratio? EPS is the primary determinant of investment valuation. So earnings per share. So EPS is, let us say, $5. That means we can say that for every one share held, the company is earning $5. Or is saal, the company has earned $5 for you. So if you're having 10 shares, the company has earned $50 for you. So this $50 पूरा का पूरा तुम्हें मिल सकता है if the company is distributing 100% dividend. अगर कंपनी इसमें से 30% डिविडेंड ही देगी, so you will get only $15 and the remaining amount is going to be held with the company in the form of retained earnings. It is preferred by the investors because it is a direct measure for return for the investors. Studies show that PE is significantly related to the long run average stock return. Now, I'll explain what is PE ratio. So let's say the company is earning $5 and currently the share price is trading at $100. So PE ratio is 20x. Okay. So this is the current market price and this is the EPS. What I'm trying to say is if the company is earning $1 in the form of net earnings, people are ready to pay $20 in order to purchase its share. मतलब if the company is earning $1, ये $1 कमाने के लिए मैं कितना कंपनी को देने रेडी हूँ? $20 by buying the share price. If PE ratio is coming as 30x, that means if the company is earning $1, I am willing to pay $30 to earn this $1. ठीक है, so this is the PE ratio. It can also be considered as a payback period. मतलब मैं $30 देके कंपनी का शेयर खरीद रहा हूँ, इस साल कंपनी मुझे मेरे लिए कितना कमा रही है? $1. That means it will take 30 years for the company to return back my investment. Now think about it. In India, we have companies जिनका PE ratio 150 है. That means if the company is earning 1, people are ready to pay $150 to earn this $1. Okay, did you understand this? What is PE ratio? How is it useful?
Yes, sir.
Why not PE? It cannot be used if there are negative earnings. The management has got capacity to distort the earnings. Earnings are more volatile than cash. किसी साल sales बहुत ज़्यादा हो सकती है, sales बहुत कम हो सकती है. Let's say COVID जैसा period है. COVID के पहले बहुत boom था, उसके बाद 2 साल sales tanked and then again sales have slowly picked up. फिर अगर हम previous 12 months का data लें, तो that is called as trailing PE और forecasted EP ले, तो that is called as forward PE. Consider recurring EPS only, exclude asset sales, other income and FX gains. तो ये जो नेट इनकम कैलकुलेट होती है उसके पहले जितने भी मींस नॉन फ्रीक्वेंट आइटम्स या इरेगुलर आइटम्स है, फॉर एग्जांपल गेन फ्रॉम सेल ऑफ प्लांट एंड मशीनरी, और अगर फॉरेन एक्सचेंज की वजह से तुम्हें कुछ प्रॉफिट और लॉस हुआ, जैसे अभी INR USD जो है वो 90 पहुंच चुकी है, तो तुमने वैल्यूएशन एज पर 80 किया था बट अब 90 हो गई है, तो तुम्हें प्रॉफिट और लॉस हुआ था. तो ये सारी चीजें कंसिस्टेंटली नहीं होगी, ये वंस इन अ टाइम वाला चीजें हैं. तो infrequent items को we have to adjust and then we have to find out how much is my normal net income. That only I can take to calculate PE. तो बहुत सारा adjustments are required. और अगर cyclical stock है तो earnings will fluctuate. किसी साल it will be high when the economy is doing well, when the economy is not doing well the earnings can be low. Also, there are some accounting differences. Let's say company A is following straight line method of depreciation. Company B is following return down value method of depreciation. Company A is following FIFO inventory valuation. B is using LIFO inventory valuation. तो valuation की वजह से भी net income can be different. ठीक है, and if there is any dilution of shares मतलब let's say I have given ESOP, employee stock option plans to my employees, तो they will exercise the option, they will become shareholders. तो क्या हो रहा है, पहले मैंने अगर $100 कमाया and I have 100 shareholders, तो every shareholder is getting $1 each. अभी अगर मेरे एम्प्लॉइज ने एक्सरसाइज कर लिया तो ये $100 में लेट्स से 100 एम्प्लॉइज ने एक्सरसाइज कर लिया, दिस बिकम्स 200 शेयर्स. Now what happens is EPS falls. EPS becomes 0.5. यहाँ पे EPS was $1. तो ये हो गया dilution of share. Yeah, moving on. So sales is better than earnings. Sales is always positive, unlike EPS. Sales is less easy to manipulate as compared to EPS or book value. Sales is less volatile compared to net income and stuff. And if we are valuing any mature or cyclical stock or startup, then also price to sales will be useful. So PS is useful for all type of firms. Why not PS? Growth in sales may not boil down to earnings, and a question will remain as to how the sales was funded. So let's take the example of Zomato, Swiggy, on any cash burning business. So इनकी सेल्स तो इंक्रीज हो सकती है, बट ये कभी भी प्रॉफिट जनरेट नहीं कर पाएंगे. क्यों? क्योंकि ये कैश बर्न कर रहे हैं इन ऑर्डर टू जनरेट दिस सेल्स. तो ये एक्चुअली अच्छी बात नहीं है. ठीक है, सो दैट इज व्हाई if sales may not boil down to earnings, because there was a question how the sales was funded. तो ये cash burn करके अगर ये sales fund हुआ है तो it's not a good sign. Then cost structure and cost production techniques are not captured. Cost structure मतलब मेरे पास debt कितना है, equity कितना है. ठीक है, अगर मेरे पास debt ज्यादा है तो बहुत सारा पैसा interest पे करने में चले जाएगा. Equity ज्यादा है तो ठीक है, interest cost is less, dividend can be paid as more. फिर प्रोडक्शन टेक्निक लेबर इंटेंसिव है या मशीन इंटेंसिव है. तो जहां लेबर इंटेंसिव है वहां स्ट्राइक वाइक होने का चांस होता है, कॉस्ट आर हायर. जहां पे मशीन इंसेंटिव होता है वहां पे मुझे इन्वेस्टमेंट्स लगेगी. ठीक है, टेक्नोलॉजी में मुझे इन्वेस्ट करना पड़ेगा, R&D में मुझे इन्वेस्ट करना पड़ेगा. सो ये वेरिएशन भी वहां पे होती है. सेल्स कैन स्टिल बी डिस्टॉर्टेड. जैसे मैंने बताया था, मैंने अपने सेल्स डिस्ट्रीब्यूशन चैनल में आई कैन पुश माई स्टॉक एंड आई कैन टेल माई डीलर्स दैट ये साल खत्म होने के बाद इसको रिटर्न कर दो, अभी फिलहाल मुझे सेल्स दिखाने के लिए चाहिए, सो कीप दिस स्टॉक विथ यू. सो सेल्स कैन ऑल्सो बी मैनिपुलेटेड. द नेक्स्ट इज प्राइस टू बुक वैल्यू. So book value is your net worth, which is your equity. It can be calculated as assets minus total liability minus preferred stock if the company has got preference stock. बुक वैल्यू में भी टैंजिबल बुक वैल्यू होता है. इसमें हम क्या करते हैं, वी आर एक्सक्लूडिंग इंटैंजिबल एसेट्स लाइक गुडविल, पेटेंट्स एक्सेट्रा. When calculating book value, we have to adjust for off balance sheet items if there is any kind of contingent liability. ठीक है, फॉर एग्जाम्पल कोई केस चालू है जिसकी वजह से मुझे पैसे देने पड़ सकते हैं, तो आई हैव टू मेक एडजस्टमेंट्स फॉर दैट. एंड अगर कोई लीजिंग है, ऑपरेटिंग लीज, फाइनेंस लीज, विच यू विल लर्न इन FSA, एंड इफ लीफो फीफो मेथड में डिफरेंस है तो वो वाली एडजस्टमेंट्स भी करनी पड़े. तो बुक वैल्यू इज बेसिकली NAV व्हाट वी यूज फॉर म्यूचुअल फंड्स. बुक वैल्यू जनरली पॉजिटिव इवन व्हेन द कंपनी सफर्स लॉसेस. मतलब एकदम कंसिस्टेंट लॉस नहीं होना चाहिए. 1-2 साल के लॉस में बुक वैल्यू इज नॉट दैट इम्पैक्टेड. It is more stable than EPS. It is the appropriate ratio to calculate NAV of financial firms. मतलब mutual funds are valued using price to book value. It is useful in the valuation of liquidating companies. Again, ये important theoretical point है. If the company is planning to shut down, तो सारे assets को बेच देंगे. तो that is why इस situation में price to book value is more important than price to earnings. Because company बंद होने वाली है तो future sales भी नहीं होगा, future earnings भी नहीं होगी. So that is why price to book value is better. It does not capture the intangibles elements like यहाँ पे कोई key personnel है, कोई important person है जिसकी वजह से business चल रही है, उसकी सब valuation नहीं होती है. So it does not capture the impact of intangibles. फिर difference in production techniques may show different asset intensity among companies. जैसे मैंने बताया था, labor intensive हो सकता है, machine incentive हो सकता है. अगर labor intensive है मतलब मेरे पास machinery कम है, people ज़्यादा है. machinery कम मतलब assets are lower. यहाँ पे मशीनरी ज्यादा मतलब एसेट्स आर हायर. तो बुक वैल्यू में डिफरेंस आ सकती है। उसके बाद देयर आर सम अकाउंटिंग डिस्टॉर्शन एज वेल। तो एफएसए में यू विल लर्न वी हैव रिसर्च एंड डेवलपमेंट कॉस्ट। तो रिसर्च कॉस्ट को हमेशा हम एक्सपेंस करते हैं, डेवलपमेंट कॉस्ट को कुछ डेवलपमेंट कॉस्ट को हम कैपिटलाइज करते हैं। एक्सपेंस मतलब वी शो इट इन द इनकम स्टेटमेंट, कैपिटलाइज मतलब वी शो इट इन द बैलेंस शीट। तो इसमें भी यूएस गैप के अलग रूल्स हैं, आईएफआरएस के अलग रूल्स हैं। तो ये सारे रूल्स की वजह से दो कंपनीज का प्राइस टू बुक वैल्यू कंपेयर करना डिफिकल्ट हो सकता है। इन्फ्लेशन एंड टेक चेंजेस कैन मेक बुक वैल्यू ऑब्सोलीट। ठीक है, सो कोको कोला, इसके बाद सीक्रेट फॉर्मूलाज हैं। टाइप राइटिंग, अचानक से नोबडी स्टार्टेड यूजिंग टाइपराइटर, तो अचानक से इसकी बुक वैल्यू बहुत ही गिर गई बिकॉज ऑब्सोलीट हो गई। ठीक है, एंड कोको कोला कैसे है कि इसकी जो सेल्स प्रोडक्ट है, प्रोडक्ट की एमआरपी है, वो इन्फ्लेशन से इंक्रीज होते रहती है। सो इज दिस क्लियर? आर यू अंडरस्टैंडिंग द थियोरेटिकल एस्पेक्ट्स?
Yes, sir.
Okay. We don't have much valuation questions in the these kind of valuation methods. We have most valuation questions in the dividend discount model only. The last is cash flow. Cash flow is very difficult to manipulate. Cash flow is more stable than price to earnings, and over here we are able to see the quality of reported earnings. So that means my net income can be very different, my cash flow from operations can be very different. तो नेट इनकम में जो प्रॉफिट जनरेट हो रही है वो एक्चुअली कैश में जनरेट हो रही है या नहीं, आई एम एबल टू डिटरमाइन यूजिंग माय सीएफओ। आई गिव अ वेरी सिंपल एग्जांपल। सो लेट्स से सेल्स मेरी 100 है और सपोज सर्विस ओरिएंटेड फर्म है, कॉस्ट अपोज मेरी कुछ भी नहीं है, तो ये पूरा का पूरा 100 में अज्यूम करता हूँ मेरी नेट प्रॉफिट है। ठीक है, तो मैंने अकाउंटिंग में नेट प्रॉफिट में तो दिखा दिया कि नेट इनकम मेरी 100 है, बट मैंने ना इनसे पैसे नहीं लिए हैं, मतलब ये मुझे पैसे देंगे बाद में, तो मेरी ऑपरेटिंग कैश फ्लो या कैश फ्लो फ्रॉम ऑपरेशंस होगा वो जीरो होगा। क्यों? एक्चुअली में कैश आया ही नहीं है। तो मैं तो दिखा रहा हूँ कि मेरी कंपनी प्रॉफिटेबल है, बट मेरे पास कैश बिल्कुल ही नहीं है। क्यों? बिकॉज इन्होंने मेरे को पे ही नहीं किया है। तो नेट इनकम दिखा रही है कि क्वालिटी अर्निंग्स है, बट कैश फ्लो फ्रॉम ऑपरेशन बता रहा है यार अर्न तो इसने किया है बट इसके पास पैसे नहीं है। सो दैट इज वाई सीएफओ इज मोर इम्पोर्टेंट। ठीक है, नाउ व्हाई नॉट प्राइस टू कैश फ्लो? इट हैज गॉट एटलीस्ट 4 डेफिनेशन ऑफ कैश फ्लो, बिकॉज हमें पता नहीं कौन सा कैश फ्लो लेना है। वी कैन टेक सीएफओ, वी कैन टेक एफसीएफएफ, वी कैन टेक एफसीएफई, देयर इज अ नॉर्मल कैश फ्लो एज वेल. So there are different cash flow variations which can be used. FCFE is better, though it is more volatile. There are other CF measures as well. तो एक formula है CF is equal to net income plus depreciation amortization. फिर एक adjusted CFO है, this is cash flow available plus net interest cash outflow multiply by 1 minus tax rate. फिर एक FCFE है, फिर एक EBITDA है. So which cash flow we have to take? वो एक question mark. So this formula we have already discussed. यहाँ पे we are able to find the price of the shares using the Gordon growth model. So we have already understood this formula. P0 is equal to D1 divided by K minus G. मैं क्या कर रहा हूँ, मैं दोनों साइड में earnings से divide कर रहा हूँ. तो I am taking expected earnings, तो वो E1 होगा, actual earnings E0 होते हैं. So यहाँ पे this becomes my justified PE ratio. D1 divided by E1 is the expected payout. So this is the payout rate. And यहाँ पे we have K minus G. So this is my justified P ratio. ठीक है, it is called justified P ratio because it represents PE based on present value of future cash. This is a leading PE ratio. एक होता है trailing मतलब historical data, leading मतलब forward expected data. Trailing PE is also called as lagging PE. This approach clearly links a firm's PE to its fundamental, showing that justified PE depends on expected dividend payout ratio, required rate of return, constant growth rate of dividends. तो ये theory question के लिए important. PE ratio, justified PE ratio depends on 3 factors. You have to remember these 3 factors. So expected payout ratio, KE and G. Justified PE act as a benchmark. ये हम starting में discuss कर चुके हैं. If the actual PE is greater than justified PE, 20x होना चाहिए 14x overvalued. ठीक है, 20x actually में होना चाहिए 25x. So this is undervalued. Issue with justified PE, it is highly sensitive to inputs, especially KE minus G. Again, अगर G K से बड़ा है तो तुम K यूज नहीं कर सकते हैं. Analysts should test multiple input sets to obtain a particular range. Since the formula comes from constant growth model DDM, the resulting PE is consistent with the constant growth assumption. मतलब we are assuming G में GS हो सकता है, G में GL भी. An important theory question over here, the justified PE increases when the dividend payout is higher, when the growth rate is higher, and the required rate is lower. So D1 divided by E1 divided by K minus G. This has to be high. This has to be high. This has to be low. Lower the better. तो अगर ये तीन conditions है, तो your PE ratio will be higher. Okay, so this again is an important theory question which you must remember. So theory wise, this is good. However, in practice, if you think about it, if the company pays more dividend, तो आज मैंने पैसे दे दिए सब कुछ, तो मेरे पास ग्रोथ के लिए पैसे कम रहेंगे ना. तो अगर मैं डिविडेंड ज्यादा दे रहा हूं तो मैं फ्यूचर पोटेंशियल ऑफ द कंपनी को इंपेयर कर रहा हूं. सो इन प्रैक्टिस, इंक्रीजिंग द पे आउट रेशियो reduces sustainable growth even though higher dividends raise value. मतलब आज तो वैल्यू ज्यादा दिखेगी, बट फ्यूचर में कंपनी के पास पैसे कम होंगे in order to grow more in the future. This trade-off is called dividend displacement earnings. Dividend displacement of earnings. Therefore, increasing the payout cannot indefinitely raise the firm's PE, or every firm will adopt a 100% payout ratio. So again, last 3 points, very important. You can get a theory question. Any doubts?
No, sir.
So let's see a formula. Analysts forecast the following for Nestle with an aim for establishing a justified forward PE. तो हमें दिया है dividend payout rate. So dividend payout rate, that means ये पूरा. This is 0.68. Long run return on equity, it is 21.5%. Required rate of return is 9. तो ये है ROE. Payout ratio अगर 68% है, तो retention rate will be 32%. Required rate of return is 9. So this is 0.09. अब मुझे G निकालना है. तो G is equal to retention rate multiplied by return on equity. ठीक है, तो 0.32 multiplied by 68%. तो ये लगभग आता है 6.9%. तो 0.09 minus 0.069. Get the answer as 32 point. ठीक है, you have to remember this formula and you have to check the question. Question में क्या दी? Take a couple of minutes. If you have any doubts, ask me. Otherwise, we'll go ahead.
Yes, sir. Done.
Done? Okay. So multiples based on comparables. So all these are comparable measures only. Price multiple comparables assesses whether a stock is properly valued related to the benchmark. The benchmarks can be stock's historical average or it can be industry average as well. So दो तरीके की comparison हो सकती है. Let's say my current P is 20x. तो इसको मैं अपने historical self से compare कर सकता हूं और इसको मैं peer group या industry से compare कर सकता हूं. So on an average मेरी PE लास्ट 10 साल में 18x थी, अब 20 हो गई है, मतलब currently it is overvalued. My peers are valued at 24x. That means currently I am undervalued. तो दो तरीके का कंपेयर हो सकता है. या तो तुम खुद से कंपेयर करके देखो क्या तुम बेटर हो रहे हो या क्या तुम पीछे जा रहे हो, or you compare with peer. Am I doing better than him or am I doing worse than him? So if I'm comparing myself by taking the historical data, it is called as time series analysis. If I'm comparing myself with my competitors, with others, it is called as cross-sectional analysis. It is based on the law of one price. Comparable assets should have similar price multiples. So अगर company A and company B दोनों सेम प्रोडक्ट बनाती है, दोनों के पास सेम डेट टू इक्विटी रेशियो है, दोनों के पास सिमिलर टाइप ऑफ एसेट्स है, तो इफ कंपनी A is having a multiple of 20x, B should also have a multiple of 20x, assuming they both are perfectly competitive. बट अगर ये सैमसंग एंड एप्पल होगा तो देन द मल्टीपल विल वेरी बिकॉज प्रोडक्ट्स अलग है, आईपी उनकी इंटेलेक्चुअल प्रॉपर्टीज अलग अलग है, टेक्नोलॉजी अलग अलग है. सो इफ two people are absolutely comparable, they should have similar multiples. Ensure firms used as comparables are truly comparable. So अगर साइज अलग अलग है, एक बड़ी फर्म एक छोटी फर्म कंपेयर नहीं हो सकती, इंडस्ट्री अलग अलग है, मैं सीमेंट और कस्टमर कंज्यूमर डिस्क्रिशनरी लाइक जोमेटो को कंपेयर नहीं कर सकता. अगर ग्रोथ अलग अलग है, एक मैच्योर्ड फर्म है एक नई फर्म है, तो देन ऑल्सो आई विल नॉट बी एबल टू कंपेयर दिस. So comparables cannot be used if these things exist. So again, it is important from theory. We cannot use comparable measures if size is different, industry is different, and growth potential is different. Another important question, अगर cyclical firm है तो PE ratios can be misleading because earnings volatile. तो इसमें हम क्या लेंगे? We will take price to sales ratio. So for cyclical firms, price to sales is better than price to earnings. So whenever you are reading these kind of things, अगर ऐसे बहुत important question, important sentences है, you have to mark it because exam के एक दिन पहले you will have to do इसके revision. Valuation may conflict with fundamental methods. Accounting differences reduces comparability, especially अगर IFRS, US GAAP, Indian accounting standards. Multiples for cyclical firms fluctuate with economic conditions. So historical method जैसे हमने टाइम सीरीज एनालिसिस बोला था वो यहाँ पे अप्लाई नहीं हो सकती. सो फॉर एग्जांपल अगर इकोनॉमी बहुत अच्छी जा रही है तो वैल्यूएशंस विल बी हायर, मल्टीपल्स विल बी हायर, और अगर इकोनॉमी इज पुअर तो वैल्यूएशंस कैन गो डाउन, मल्टीपल्स कैन आल्सो गो डाउन. सो साइक्लिकल फर्म्स के लिए मल्टीपल्स थोड़ा केयरफुली यूज करना है. सेकेंड मेथड ऑफ वैल्यूएशन इज EV by EBITDA. सो EV by EBITDA. EV is enterprise value and this is earnings before interest, tax, depreciation and amortization. ये वाला जो अमाउंट है ये हमें इनकम स्टेटमेंट से मिलेगा और ये वाला जो अमाउंट है ये हमें बैलेंस शीट से मिलेगा. EBITDA is a direct measure, it is available in the income statement. EV we have to calculate. ठीक है. EV का फॉर्मूला इज मार्केट वैल्यू ऑफ इक्विटी, आगे लिखा होगा मार्केट वैल्यू ऑफ इक्विटी प्लस डेट, ठीक है, माइनस कैश. हम कैश माइनस इसीलिए करते हैं बिकॉज वील अज्यूम दैट कैश इज यूटिलाइज टू रीपे द डेट. और अगर बुक वैल्यूज और मार्केट वैल्यूज दिए हैं तो तुम्हें मार्केट वैल्यूज ही लेंगे. तो एंटरप्राइज वैल्यू का सिंपल फॉर्मूला इज मार्केट वैल्यू ऑफ इक्विटी प्लस मार्केट वैल्यू ऑफ डेट माइनस कैश. EV represents the total company value. That is, if you want to acquire this firm, what is the amount that you have to pay? तो कंपनी के पास जो एग्जिस्टिंग कैश है वो मैं यूटिलाइज करूंगा डेट को रीपे करने. तो मुझे अगर ये कंपनी खरीदना है तो आई हैव टू बाय आउट ऑल द इक्विटी शेयर होल्डर्स एंड हाउ मच अमाउंट ऑफ डेट इज रिमेनिंग. EV is especially useful for comparing firms with different capital structures. So again, it's an important point. If capital structures are different, मतलब debt to equity ratio अलग अलग है. एक फर्म के पास डेट है, इक्विटी है, दूसरे फर्म्स के पास डेट है, इक्विटी है, प्रेफरेंस शेयर्स है. तो इनको आपको कंपेयर करने के लिए यू विल हैव टू यूज EV by EBITDA. Operating income, EBIT, can also be used. Because EV represents values to both debt holders and equity holders, it must be compared with earnings attributable to both groups. तो हम डिनोमिनेटर में EBITDA या EBIT लेते हैं because it is the earnings available for all contributors of capital. हम डिनोमिनेटर में नेट इनकम नहीं लेते हैं बिकॉज नेट इनकम इज एट्रीब्यूटेबल ओनली टू इक्विटी होल्डर्स. जब न्यूमरेटर में हम डेट को भी कंसिडर कर रहे हैं तो डिनोमिनेटर में भी वही मेजर लेना चाहिए जो डेट होल्डर्स को भी दिया जा सकता है. EBITDA is usually positive even when net income is negative. तो अगर बहुत सारा पैसा इंटरेस्ट पे करने और टैक्स पे करने में चले जाएगा तो अर्निंग्स विल बिकम नेगेटिव. It avoids issues when earnings based multiples becomes meaningless. तो when P price to sales ये सारी चीजें यूज नहीं हो सकती. Another alternative is using EV by EBITDA. Limitations of EBITDA, it may include non-cash revenue and expenses, reducing accuracy. So there can be some non-cash transactions like gains or losses on sale of machinery, any revaluation, forex में अगर कुछ profit loss होता है जिसकी वजह से fluctuations होती हैं, ठीक है. So all that may distort the value of EBITDA. Market value of debt is often unavailable if debt is not traded in the market. So this is another challenge. Analysts may use market value of similar bonds or book values, but book value will be unreliable when economic conditions have changed since the issuance. तो fixed income में तुम्हें समझ में आ जाएगा. अगर bonds listed है तो you will get the market value. अगर listed नहीं है तो what I'll do is I'll compare my bond with similar listed bonds. उनका जो market value है वो मेरा market value हो जाएगा, ठीक है. और अगर let's say bonds कंपनी ने historically issue किया था, they are paying a coupon of 8%. अभी मार्केट में इंटरेस्ट रेट चल रही है 10%, तो मेरी वैल्यूएशन 8% से होगी बट एक्चुअल वैल्यूएशन 10% से होनी चाहिए. तो अगर बुक वैल्यूज हम ले रहे हैं तो करंट मार्केट कंडीशंस उसमें रिफ्लेक्ट नहीं. इज दिस स्लाइड क्लियर? हेलो, आर यू फॉलोइंग?
Yes, sir. Yes, sir.
Yeah, okay. So here's an example. So we have to calculate EV by EBITDA. And industry average EV by EBITDA is given. So we'll also be able to conclude whether my stock is overvalued or undervalued. ठीक है, तो सबसे पहले एंटरप्राइज वैल्यू निकालते हैं. ईवी का फॉर्मूला इज इक्विटी मार्केट वैल्यू प्लस डेट मार्केट वैल्यू माइनस कैश. सो स्टॉक प्राइस दिया है एंड नंबर ऑफ शेयर्स दिए, तो इन दोनों को वी कैन मल्टीप्लाई. वील गेट द वैल्यू ऑफ इक्विटी. इक्विटी विल बी 30 million. डेट का मार्केट वैल्यू दिया है, बुक वैल्यू दिया है. We'll obviously take the market value if it is given. So plus 7.8 million. We have to reduce cash. ठीक है, तो इसमें से you reduce cash 0.045. So if you solve this, इसका आंसर आएगा around 37.75 million. So this is my EV. ऑपरेटिंग प्रॉफिट इज EBIT. हमें चाहिए EBITDA, तो इसको ऐड करना पड़ेगा. EBITDA इज 3.6 million. So 37.75 divided by 3.6 million. This will give me answer which is around 10.5x. So my company का EV by EBITDA is 10.5x, industry का is 10.2. So क्या conclusion निकालोगे आप?
It is undervalued.
नहीं,
No,
मेरी 10.
overvalued. Overvalued.
हाँ, करेक्ट. मेरी 10.5 है, इंडस्ट्री में बाकी सबकी 10.2. तो अब फॉर्मूला लिख लेना, ठीक है, बिकॉज फॉर्मूला शायद मिसिंग था. एंटरप्राइज वैल्यू इज इक्वल टू मार्केट वैल्यू ऑफ इक्विटी प्लस मार्केट वैल्यू ऑफ डेट माइनस कैश. अगर डेट का मार्केट वैल्यू नहीं दिया है तो यू कैन इवन टेक द बुक वैल्यू, बट इक्विटी का मार्केट वैल्यू हमेशा अवेलेबल होगा ही. So let me know if you have any doubt, otherwise we'll go ahead.
Yes, sir. We can go ahead.
Okay. Then we have asset based valuation model. So as discussed before, this is useful when we are calculating NAV. तो म्यूचुअल फंड्स के लिए इजी है बिकॉज एसेट्स उनके पास सारे इन्वेस्टमेंट्स ही होंगे, लाइबिलिटी भी उनकी मॉनिटरी लाइबिलिटी भी ही होगी, तो इजीली हम रिड्यूस कर सकते हैं. एंड इट कैन ऑल्सो बी यूज्ड व्हेन द बिजनेस इज प्लानिंग टू शट डाउन. So formula is fair value of assets minus fair value of liability. This is important. It's not book value, it is fair value. मतलब currently at what price you will be able to sell your assets और मेरी liabilities को मुझे कितना देना पड़ेगा in order to repay them. Market values are hard to observe, so analysts adjust balance sheet values using depreciated values, inflation adjusted values, replacement values. So maybe अगर मैंने customized property plant and equipment बनाया होगा तो उसकी मुझे करंट वैल्यू निकालना काफी डिफिकल्ट होगा. सो व्हाट आई डू इज डेप्रिसिएट करके कितने में बिक सकता है, रिटर्न डाउन वैल्यू. और अगर मुझे सिमिलर एसेट अभी बनाना है तो कितना कॉस्ट लगेगा, दैट इज इन्फ्लेशन एडजस्टेड वैल्यू, और दैट इज ऑल्सो रिप्लेसमेंट एडजस्ट वैल्यू इफ आई वांट टू मेक द सेम मशीनरी अगेन. This can only be used if the company has got physical assets. It is difficult to apply. So ये important theory है. It is difficult to apply when the firm has significant intangible assets like goodwill, patents, trademarks, etc. because this may be hard to measure. Asset-based valuations often serve as a floor estimate. मतलब this is the bare minimum value when intangible play a major role. So when company has got more intangibles like IT, ठीक है, तो आईटी में तुम एसेट बेस्ड वैल्यूएशन मॉडल्स नहीं यूज कर पाओगे बिकॉज उनके पास सॉफ्टवेयर, पेटेंट्स, ट्रेडमार्क्स ये सब ज्यादा होंगे. इट शुड बी सप्लीमेंटेड विद फॉरवर्ड लुकिंग मेथड लाइक डिस्काउंटेड कैश फ्लोज. तो तुम वैल्यूएशन दोनों करके देखो एंड देन कंपेयर विच इक्विटी वैल्यू इज रीजनेबल. It is most reliable when the firm has more tangible assets, or even short-term assets are fine, which is current assets, or it has got assets जिसकी market value हम निकाल सकते हैं, or there is a liquidation scenario. It is commonly used for private firms and it is becoming increasingly relevant because public firms are following fair value reporting now under IFRS. So everything is summarized over here. This is a very important table which you can go through. I've explained majority of the things over here. ठीक है, तो एसेट बेस्ड वैल्यूएशन मॉडल इट इज हार्ड टू असेस ड्यूरिंग हाइपर इन्फ्लेशन. हाइपर इन्फ्लेशन मतलब देर आर सम कंट्रीज जिनमें जहाँ पे इन्फ्लेशन रेट बहुत ज़्यादा है, इट्स 20%, 30%, मोर देन 100%. तो वैसे सारे सिचुएशंस में एसेट बेस्ड वैल्यूएशन मॉडल्स कैन नॉट बी यूज्ड. So just quickly going through this, especially the disadvantages. TCF में very sensitive to assumptions. Comparables में अगर अकाउंटिंग मेथड्स डिफरेंट है तो अकाउंटिंग मेथड्स की वजह से वेरिएशंस आ सकता है. ठीक है, साइज की वजह से वेरिएशन आ सकता है. ठीक है, एसेट्स में लेबर इंटेंसिव, मशीनरी इंसेंटिव, उसकी वजह से ये डिफरेंस आ सकता है. एंड देन अगर इकोनॉमिक साइकिल्स में सेंसिटिव है, फॉर एग्जांपल साइक्लिकल, तो प्रॉब्लम आ सकती है. ठीक है, और अगर वी कैन नॉट वैल्यू सर्टन एसेट्स लाइक इंपॉर्टेंस ऑफ अ पर्टिकुलर पर्सन, जैसे कोक के पास कोई एक सीक्रेट फॉर्मूला है, ठीक है, जिसकी वजह से उनकी वैल्यूएशन ज़्यादा है. ठीक है, सो दोज काइंड ऑफ थिंग्स विल ऑलवेज कॉन्फ्लिक्ट. It will be hard to value. Price multiples based on fundamentals. So it is very sensitive to inputs, especially K minus G. अगर G ज़्यादा है तो you'll not be able to use this form. Asset based valuation model, अगर intangibles ज़्यादा है तो you will not be able to use this model. So this is the summary. Let's do some questions. Which of the following is least likely a rationale to use price multiples? So least likely a rationale मतलब कोई statement जो गलत है. Price multiples are easily calculated. Okay, possible. P ratio is insensitive to its inputs. ठीक है, earnings अगर बहुत volatile हैं तो things can vary. The use of forward values in the divisor provides an incorporation of a future. ये actually अच्छी बात है. Insensitive नहीं है, it's actually sensitive. Okay, so one answer is B. Correct. One answer is B. Firm is having an expected dividend payout ratio of 60%. So formula हमारा है P divided by E is equal to P1 divided by E1 divided by K minus G. Expected dividend payout ratio 60%, 0.6. Future growth rate 0.07. Required rate of return is 0.15. ठीक है, तो 0.6 डिवाइड बाय 0.8.
ऑप्शन बी.
ठीक है, ऑप्शन बी 7.5. Enterprise value is defined as, so इसका आंसर बताओ. It's just a formula. Market value of equity plus.
Option B.
Correct. Market value of debt minus cash and short term investments. अगर मार्केट वैल्यू अवेलेबल नहीं है तभी हम फेस वैल्यू लेते हैं. अदरवाइज मार्केट वैल्यू इज व्हाट वी. Which of the following firms would most appropriately be valued using an asset based model? So तुम्हें थियरी याद रखनी है. जिसके पास इंटेंजिबल्स ज्यादा है यूज नहीं हो सकती, हाइपर इन्फ्लेशनरी एनवायरनमेंट यूज नहीं हो सकती, शट डाउन होने वाला है, उसमें इट इज प्रोबेबली यूज्ड.
I guess option C.
सी सॉफ्टवेयर फर्म है ना, इंटेंजिबल ज्यादा है तो कैन नॉट यूज. टैंजिबल एसेट ज्यादा होने चाहिए.
Then it could be option B because it is a paper form, right?
हाँ, लेकिन यहाँ पे लिखा है ना हाई इन्फ्लेशन, हाइपर इन्फ्लेशन में यूज नहीं हो सकता. ठीक है, तो आंसर इज
Okay, okay, okay.
एनर्जी एक्सप्लोरेशन फर्म है, मतलब इसके पास फिजिकल एसेट्स होंगे ना. जैसे फॉर एग्जांपल कोल, अगर कोल माइनिंग कर रही है तो इसके पास साइट होगा. ठीक है, मशीनरी और इक्विपमेंट होगा, तो टैंजिबल एसेट्स है. यहाँ पे फिनेंशियल डिस्ट्रेस में है, इट शुड नॉट कंफ्यूज यू. ठीक है, बट इसके पास ड्रिलिंग राइट्स है ऑफशोर एरियाज में. ठीक है, ड्रिलिंग राइट्स की वैल्यूएशन हो सकती है. क्यों? बिकॉज अगर ये कंपनी नहीं काम करेगी कोई और काम करेगा. सो थियरी इज इंपॉर्टेंट. इन्फ्लेशन ज्यादा नहीं होना चाहिए, इंटेंजिबल्स ज्यादा नहीं होना चाहिए, कंपनी शटडाउन वाले पोजीशन में होनी चाहिए. ठीक है, फिजिकल एसेट्स ज्यादा होने चाहिए. तो यू हैव टू रिमेंबर सर्टेन कंडीशन, देन इट बिकम्स इजी. So last one, which type of valuation model is viewed as having the disadvantage of producing results that may not be comparable across firms?
Option C, discounted cash flow model.
Discounted cash flow में ना, ठीक है, अगर फर्म डिविडेंड पेइंग है तो ठीक है, अदरवाइज आई कैन यूज FCFE. FCFE है ना, अकाउंटिंग मैनिपुलेशंस इसमें नहीं काम आते हैं. व्हाई? बिकॉज दिस इज बेस्ड ऑन कैश फ्लोस. ठीक है, तो कंपनी में यहाँ पे एसेट अलग नहीं हो सकते हैं, अर्निंग्स अलग नहीं हो सकता है, बिकॉज एवरीथिंग इज बेस्ड ऑन कैश फ्लो. कंपेरेबल अक्रॉस फर्म्स, फर्म्स के अक्रॉस कंपेयर नहीं हो सकता. वो प्राइमरी रीजन क्या है? अकाउंटिंग डिफरेंसेस. ठीक है, डेट इक्विटी रेशियो डिफरेंसेस, टैंजिबल इंटैंजिबल ज्यादा है उसका डिफरेंस. DCF is based on dividend and FCFE which is based on cash flow. So this is not the answer. तो तुम्हारा आंसर या तो एसेट बेस्ड मॉडल होगा या प्राइस मल्टीपल बेस्ड मॉडल होगा. बट इसमें से सबसे ज्यादा सेंसिटिव कौन सी है? एसेट बेस्ड मॉडल इज बेस्ड ऑन बैलेंस शीट. प्राइस मल्टीपल मॉडल इज बेस्ड ऑन इनकम स्टेटमेंट. सबसे ज्यादा मैनिपुलेट क्या हो सकता है? इनकम स्टेटमेंट. ठीक है, तो ये
Income statement.
ओके, या सो वी आर डन विथ इक्विटी.